at it again. Now we're at Chapter 3. Remember last lecture I left off with this unadjusted trial balance that you pulled off of the journal ledger accounts. Well, now we're going to work on adjusting those accounts. And this is Learning Objective 1, and that's to describe the nature of the adjusting process. And why would you want to adjust? Well, for one thing, we have an accounting period concept. So that requires that all the revenues and all the expenses within that period be accounted for and reported in that correct period. So you would look at it and say, well, why wouldn't it? Why haven't we already got that? So basically the reason why is because some expenses run past the period or don't get recorded until the next period. Revenues would be the same way. So under the accrual basis accounting, revenues are reported on the income statement in the period in which they're earned. Okay? Makes perfect sense to me. Note, earned, not paid. So even if you don't have the money for that revenue, you need to report it in that period. Now that brings up a really interesting concept called the revenue recognition concept. And that's what it's called when you do the work but you don't have the money. So it's a concept that you have to wrap around for accounting. Now, once you have the revenue, okay, if I have the correct revenue, I also have to have the correct expenses. And that is called the matching concept or the matching principles. So that means whatever revenue I have in there, whatever expenses I incurred while creating that revenue or providing that service also needs to be matched against the revenue. So that is a little bit about what all the adjusting is about. We're looking at revenue that money hasn't been received yet, or all of it hasn't been completed yet, or expenses that may have already been incurred but not recorded. And I'll give you some examples of those in just a second. And one final note, there is an accounting method out there that's called the cash basis accounting, where you recognize revenues and expenses when you pay them. Revenues when you receive the cash and expenses when you pay for them. Many mom and pops use that. So just an idea. So two types of accounting systems: the accrual, which uses the revenue recognition and matching principle, and the cash basis, which only looks at when the cash is received and paid out. So as we move on, the adjusting process. Okay, there are some accounts that will need to be updated. Now, what are those accounts and why? Well, number one, some expenses, right here, aren't recorded daily. So you may not record depreciation every day. You may not record wages every day. Obviously, you wouldn't wages simply because you only pay them once a week or maybe every 2 weeks. Revenues and expenses may not have come in on the same transaction, so you may have to be adjusted. And some revenues and expenses just simply may not be recorded yet. They're just they haven't. You haven't received an invoice for them, or you haven't sent out an invoice for them. So that's the adjusting process and using the accrual basis. So what we have to go through is we have to analyze all of the accounts and all of the work we've done for that particular period. And usually this period is monthly now. It used to be quarterly. But now with the advent of computers, it's so much easier to do it on a monthly basis. Actually, you could set up a program to do it on a daily basis if you wanted to, but that would be probably a tad much. So you're going to go through an adjusting process, and you are going to have to make adjusting entries. And those entries would go in the general journal and then be posted to the ledger. So let's keep going, and I can give you some examples. So the types of accounts that are going to require adjusting. How about prepaid expenses? Remember back last week we had a prepaid insurance expense. So we actually spent, I don't know, $300-400 for insurance that's going to spread over 3 months. So each month when we close, we're only going to recognize a portion of that as an expense. Accrued revenues, and again, those are revenues that are unrecorded, or at least they aren't recorded as revenues. A good example of that would be interest revenue. Let's say you have a note receivable out, and somebody's going to pay for that note receivable in 6 months. But each month, that note is earning interest, and that has to be recognized as revenue at the end of the period. Typically, you wouldn't recognize that until they paid the full note receivable with the interest. But with an accrual system, you're going to recognize that 1 month. And accrued expenses, a very good example of that is wages. What if you paid, I don't know, every 2 weeks, and the period ends and they won't get paid until 1 week into the next period? Well, you would have a whole week of expenses that actually went into the period you're closing. So you have to take that into account and adjust it. So let's look at examples now. Now that I've totally confused you. Here's prepaid expense. Okay, we had a prepaid expense. We put it in, okay, and we paid for it. And we just kind of swapped here on the assets in the equation. The cash went down, but the prepaid expense is an asset. Notice that's not an expense yet. It's a prepaid expense. So now we have a revenue, and then to recognize this, we would take and do an entry that actually turned this asset into an expense. So it would be a credit to prepaid expense and a debit to the actual expense you were recognizing. In this one, this is looking at, remember I talked about the interest? Well, let's look at this and say we had a 12-month note receivable, and each month there was $100 worth of interest due. So we're at the end of this period, and we need to record 1 month of the interest as an revenue. So I would hit revenue with $100 here, and interest receivable with $100. And you can see how that would keep the equation going. Now let's look at one more, and you can see it. Now this one is an expense. It's an expense, but nothing has been recorded. And this is what we will record. This is an expense we've found, and it is going to be debited in the expense and then credited to a liability. Again, it keeps the equation in balance. Such as we had wages payable, $1,200, and that was for 2 weeks out. We would only have an expense for this period of $600 and adjust that liability. So that's kind of an overview of what we're going to be doing with the nature of the adjusting process. We will get into a full-blown one in the next, a full-blown example with real numbers in the next video. Thank you.